Hello, self-storage investors. Coach Rowell here. In today's video, I wanted to share with you the importance of knowing your numbers. And as I often like to do, I like to first establish motivation, your why. Why should I bother knowing my numbers, you might be thinking. Now, the three main benefits to you for knowing your numbers are you're going to be able to make good investing decisions. Now, hopefully you'll make at least better investing decisions. And better investing decisions largely come from a place of objectivity. So knowing your numbers will help you to remain as objective as possible. And the essence, or essentially the role of any investor, is really to be able to determine the most efficient use of one's money. Now, any conversation regarding numbers in self-storage investing will inevitably touch upon something called a capitalization rate, better known as a cap rate in the commercial real estate investing world. A cap rate is essentially an estimate of the return that an investor will receive from a given investment property. In this case, the return that you may reasonably expect by investing in a self-storage facility that you may be looking to acquire. Now, the cap rate is very simply determined by taking your NOI and dividing that by your price. So there you go, cap rate, done in the video. Just kidding. The NOI, you may be asking, what the heck is that? It stands for net operating income. And that is calculated by taking your gross income and subtracting your operating expenses. Now, what is an operating expense? Think about anything, any expense that is required to be able to run a given facility or investment property. Things like your property taxes, your property insurance, management fees, both on-site as well as off-site management fees, repairs and maintenance, utilities, and any other miscellaneous expense. What operating expenses does not include is debt interest, income tax, depreciation, and amortization. Some of us from the business world might recognize this as making up the term EBITDA, EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. The reason for that is any of those things, those four terms that I just mentioned, they are independent from the operation of a self-storage facility. So for example, if you can imagine a self-storage facility that both of us may be considering acquiring, you might buy the facility with all cash. So therefore you would have no mortgage, meaning you would have no interest to pay on any loans, and you would have no amortization, meaning you would have no monthly mortgage payments. I, on the other hand, would, let's say for example, I would be considering purchasing that exact same facility, but I would be using a mortgage of say 50%. So therefore I would have interest to pay on my mortgage loan, and I would have monthly mortgage payments or amortization. The way you finance the facility, or lack thereof, versus the way I would finance the facility really has no bearing upon the day-to-day operation of the facility itself. Furthermore, you may have a different tax structure that you would hold the facility in than I might have, which would then cause us to have different tax rates on the same amount of profit. So as you can see, debt interest, income tax, depreciation, and amortization is largely investor specific, and it's not investment specific. NOI, or net operating income, is very similar to EBITDA in the business world. So NOI is commercial real estate, self-storage facilities, and it's very similar to EBITDA, earnings before interest, taxes, depreciation, and amortization in the business world. The other factor there is price, which could be referring to asking price, purchase price, or market price. So let's understand this a little bit further by playing a fun game that I like to call Would You Rather. Would you rather facility A, which is asking $1.9 million, or would you rather facility B, which is asking $700,000? Now, full warning, this slide is going to be full with numbers, so strap on your seatbelts. I'll try to take it slow at first and then we'll speed it up. So we need a little bit more information, don't we? Facility A generates a gross income of $460,000, whereas Facility B generates $160,000. The cost for generating that income on Facility A is $293,000. Facility B requires $110,000 to be able to generate its gross income. So let's fill out the blanks, or fill in the blanks on the Facility A side first. Remember, net operating income is calculated by taking your gross income and subtracting your operating expenses. So, like in grade school, let's fill in the blanks there. Income is $465,000. Operating expenses, $293,000, for an NOI of $172,000. So remember that number. We're going to use it again later. NOI divided by price will give us our cap rate. So 172,000 NOI divided by an asking price of 1.9 million gives us a cap rate of 9.1% for Facility A. Now let's do the same for Facility B, but we'll go a little bit faster. So the NOI for Facility B is $160,000 of income minus $110,000 of expenses, giving us $50,000 in NOI. And the cap rate is calculated by taking the $50,000 NOI, dividing that by the $700,000 asking price, giving us a cap rate of 7.14%. So let's imagine this. Imagine these two facilities are just two listings out of 100 listings that you're looking at. And you really don't have the time, it's not really an efficient use of your time to do a deep dive into the numbers for all 100 listings, would it? So the more efficient way to do it is to set up some minimum criteria for you to be able to take a closer look at only the facilities that are really worth your time. So let's say you set up a criteria for yourself of a 9% cap rate, right? So you say, I'm only going to take a closer look to the facilities that return a 9% cap rate or better. So you go through 100 different listings. Facility B comes across your desk. You see it's a 7.14% cap rate. You really don't need to know all of the details. Basically, all you need to know are what's the asking price and what's the cap rate. So Facility A comes across your desk. Asking price 1.9 million. Great, cap rate 9.1%. Put that into the short list. Facility B comes across your desk. Asking price 700,000. Cap rate 7.14%. Okay, we put that back, we throw that fish back into the lake, right? So what you end up with after going through all 100 listings fairly quickly is you end up with a short list of, let's say, 7 listings that all have a cap rate of 9% or greater. Now you can take those 7 listings and do a deeper dive into the numbers. You determine what are they paying for property taxes, what are they paying for management fees. Is there an opportunity to lower the expenses, which will have a direct effect on the cap rate? Because as we saw with the calculation earlier, if you can lower your operating expenses, the direct effect is that you actually increase the cap rate. So by understanding the numbers, do you think you'll be able to make better investing decisions? I would say yes. By understanding the numbers, would you be able to remain as objective as possible? Yes. As they say, figures never lie and liars never figure. So numbers are very objective, right? And then by also knowing your numbers, would you be able to determine the most efficient use of your money? Of course, by the numbers, it's a resounding yes yet again. Now, I know I went a little bit fast on that and there was a lot of numbers, But that was kind of by design because I know this is recorded. So feel free to review this video one or two or three more times, or as many times as you need to be able to get comfortable with this concept. But until next time, again, my name's Coach Rowell, and I'd like to thank you for stopping by Self Storage Investing and hope to see you in a future video.